All right, let's dive right in. Today, we're talking about a strategy where some companies will literally send you cash just for owning their stock. It's called capturing a dividend, and we are going to break down exactly how it works. So let me ask you this. What if your stocks could send you a paycheck? I'm not talking about selling them for a profit. I mean actually getting paid in cash just for holding on to them. That's the powerful idea we're going to unpack today. So, first things first, Section 1, Stocks that Pay You. Let's look at how some companies share their success directly with you, the investor. It's actually a pretty simple idea. When a company turns a profit, it's got a choice. It can pour all that money back into growing the business, or it can share a piece of the pie with its owners, the shareholders. And that little slice of profit they send you, that's a dividend. A key way to measure it is the dividend yield. It's just a quick percentage that tells you how big that payment is compared to the stock's price. So who are these companies? Well, what's really interesting here is you start to see a pattern. We're usually talking about big, stable, established businesses. Think about it. Utility companies that keep our lights on, consumer staples selling stuff we buy every day, and of course, major banks. And then you have this special club called the Dividend Aristocrats. These are the rock stars, companies that have been consistently increasing their dividends for decades. Total household names. Okay, Siri is great, but to really get this, let's make it real. We're going to follow a trader through an actual scenario. They're investing in a utility company, and this little story is going to be our guide for the rest of this explainer. And that brings us to Section 2, the dividend timeline. This is where we get into the nitty-gritty, because when it comes to capturing a dividend, timing is, well, it's everything. This timeline lays it all out perfectly. First, about 2 weeks before the cutoff, our trader buys their shares. Then, the most important day on the calendar arrives, the ex-dividend date. And finally, boom, payment day. The cash dividend hits their account. Simple as that. But trust me, one of these dates is way more important than the others. And that is the ex-dividend date. Seriously, if you remember only one term from this whole thing, make it this one. To get that cash, you absolutely positively must own the stock before this date. Think of it like the official cutoff. If you buy the stock on or after this date, that dividend payment goes to the person who sold it to you, not you. The source material really nails it with this quote. The trader will receive the dividend payment as long as they own the shares before the cutoff date. It's that simple. You've got to be on the company's books as a shareholder before that date to get paid. Okay, so our trader got the timing right. The dividend is in their account. Awesome. But that's not the end of the story. In fact, it's where a whole new strategy can begin, which brings us to Section 3, the compounding snowball. This is where things can get really, really powerful. So instead of just pocketing the cash, a lot of investors use something called a DIP. It stands for Dividend Reinvestment Plan. It's basically an automated system that takes your cash dividend and, poof, immediately uses it to buy you more shares of that exact same stock. A lot of times, you don't even have to pay a commission. So you've got this fundamental choice. You can take the dividend as cash, like a little income stream, or you can use it to automatically build a bigger and bigger stake in the company. You're turning that small stream of income into a growing river of ownership. And this chart, man, it just says it all. Look at the first bar. That's your investment's value if you just took the cash every time. Not bad. But now look at the second bar, the one with the drip. That huge difference, that's the magic of compounding. Every new share you get starts earning its own dividends, which then buy you more shares. And that snowball just keeps rolling and getting bigger and faster down the hill. All right, let's zoom out from our utility company example for a second. Section 4 covers the dividend trader's checklist. Think of this as the general mindset, the overall game plan. This slide really breaks down the whole thought process. Step 1, you find companies with a solid track record of paying dividends. 2, you do your homework on their financial health. You don't want any surprises. 3, the big one, buy the shares before that ex-dividend date. 4, you make the choice, cash or drip. And 5, you keep an eye on the company to make sure that dividend payment still looks safe and sound down the road. So how do you check a company's financial health? Well, one of the key tools in your toolbox is the payout ratio. It's just the percentage of a company's profits that is paying out as dividends. So if a ratio is 50%, it means half the profits are going to shareholders. A healthy range is often 30 to 60%. But if you see a company paying out 100% or more, that could be a huge red flag that the dividend isn't sustainable. And what's really cool is that a tool like the payout ratio isn't just a one-trick pony. A dividend trader looks at it and asks, is this dividend safe?
But a value trader might look at that same number and ask, is this company managing its money well? So it's a super versatile metric.
We have covered a ton of ground, so to make sure it all sticks, let's lock it in with Section 5, your key vocabulary. This is your essential dividend toolkit. This slide right here is your cheat sheet. That dividend yield we talked about, that shows you the return you're getting. The ex-dividend date, that's your all-important must-own-by deadline. The payout ratio is your safety check. And a dividend aristocrat, well, that's just a company with a long, long history of reliability.
And that reliability is earned over a long, long time. We're talking 25 plus years. That's more than a quarter century of increasing their dividend payments, year in, year out, through good times and bad. It is the ultimate signal of stability.
So, there you have it. You've got the playbook, you know the timeline for capturing that payment, and you've got the tools to check if a company is stable. So, I'll just leave you with this question. How could a steady stream of dividends fit into your own financial goals?